There we go. All right, folks, welcome back to another REV Real Estate Live. My name is Dallin Schultz. I'm the president at REV Equity Group. We focus on apartment acquisitions and investments. And during these weekly webinars, we don't solicit any deals. These webinars are strictly education to prep you to become a more well-equipped passive investor, whether that's with us or with another group. There's not enough of this information out there. And so that's why we put these on, is to get that information out there and be able to answer questions live time for anyone that might have them. So excited about talking about our topic today. We have our guest presenter here, Brandon Harrington, and we'll introduce him here in a minute, but this is such a hot topic right now in the apartment investing space, and that's lending, loans. Where are we at? What type of leverage can you get? What's happening to these loans that are coming due? And that process there. So there's pros and cons to the current market and the state that we're in that we'll let Brandon talk to in a little bit. So as mentioned before, we're going to keep these webinars down to about 30 minutes, 30 minutes, and then open it up for some Q&A. So the reason for that is so that we can be more intentional in a more concentrated period of time and get to the point. So what I want to start with real quick is talking about a capital stack. Now, I'm going to introduce the basic concept, help you understand it, and see where debt financing or senior debt and common equity plays in, because it's important to understand how these things work into a multifamily deal. So you've got your capital stack here. What you might typically see is on this lower part, this is your senior debt. And what I mean by senior debt is that's the loan, the banks that are coming in, and they might be putting up previously 80-85%. Brandon, what would you say now? Like 50% is probably average?
50 to 65, depending on
50 to 65, right? So again, that's going to adjust, but just for understanding's sakes, we'll say the senior debt comes in and covers 75% of the loan. Okay, let's say you've got a property that's $10 million, 75%, they're going to come in with 7.5 million, which leaves the common equity being 25%. Now the common equity is going to be further split up because you're going to have GP shares and you're going to have LP shares, which might make up 80%, 20%. So it's important to understand how the capital stack works in a deal, because you might have, there's pref equity, there's mezzanine debt, there's other debt that can fall between the senior debt and the common equity. So I don't know any of these deals that aren't being purchased with bank financing because you can get very competitive terms. I'd rather pay 5% to a bank than 16% to an investor. So this common equity, this is where the passive investors, this is where us as a REV and passive investors come together to come up with this 25%. So we're raising, remember, 7.5 million here, 2.5 million for the common equity. That's what we partner up with other investors on to bring into the deal. So this is a very basic capital stack. It's important to understand how this flows, because this is how the debt gets paid back. Senior debt, then you might have your mezzanine, then you might have pref, then common equity. So we're not going to get into those other ones on this call, but again, just simply giving you a visualization of how this breaks down. Now this 25% of common equity, it might break out to an 80-20 split between the operators and the investors. Every deal is a little bit different, but understanding this before you get into a deal is super important. So I just wanted to start off with that But what I want to do now is turn the time over to Brandon because we are in some exciting times in real estate. And there's going to be a lot of opportunities presenting themselves if you're purchasing them the right way. So we're going to be talking for the next 25 minutes or so, some of the things that Brandon has been seeing in the capital markets, as well as the pros and cons of these shifts that are occurring. So without further ado, Brandon, we'll turn the time over to you. If you wouldn't mind taking just a couple minutes, introduce yourself, let everyone know your background, and then we'll go ahead and get into it.
Well, thanks for having me. I appreciate it. Brandon Harrington. I run Northmark's debt and equity for the Southwest. Northmark is one of the largest, well, we are the largest privately held Fannie, Freddie, HUD lender. We also represent about 45 or so life insurance companies here in the Southwest and do brokerage, debt and investment sales brokerage as well. I've been in the Phoenix market doing this for about 20 years now. Really, in about 2010, I used to do all product types. In about 2010, really focused and changed to 100% multifamily. So everything multifamily, we're kind of involved in it, from debt and equity raises for construction of new product to value add and senior, student, everything in between there. If it's focused on multifamily, we've touched it. We're typically in this office doing about $2 billion or so in multifamily loans a year. And like you said, it's very interesting times. We kind of really flow with where the capital flows. The last few years, the capital flow was very cheap bridge debt through debt funds and different organizations that were offering, these short-term 3-year deals with 2 1-year option. Were extremely popular. I think 90% of our business in 2021 and a little less in 2022 was bridge debt, because it was very cheap, rates were very low, and it allowed you to get the most leverage and allowed you to capitalize your rehab dollars as well. Things have definitely changed now. We've kind of gotten back to just old school real estate where location matters, property matters, demographics, etc. And it's definitely interesting now. We can kind of go into the different what's popular, but the banking situation with SVB kind of failing, Signature Bank, which on the East Coast, which is a big multifamily and commercial real estate lender. Obviously, you got First Republic in the news over the last couple of days as they just announced their quarterly results and had a pretty big run on their deposits. So, right now it's important to just be kind of cognizant of everything going on in the financial markets and where there's still opportunities with lenders. We're a Fannie Freddie lender, and one of the best things about that is they are pretty much government run entities now, and their charter is to be in the market no matter what's going on. So when there's kind of some banking issues, banks are tightening up on credit, they're there, they're continuing to do the business that they do, which is great. It's that's one of the reasons why multifamily is so great. It's because there's always that liquidity and capital available. Whereas if you're in office, retail, that capital from the financing side can be tough to come by, especially right now on the office side. You'd be very hard pressed to find any lender in the country to finance an office deal unless it's very straightforward down the fairway deal.
Brandon, let's touch on that for a quick minute, because I've been sharing with a lot of our investors that are newer to the multifamily space, because they're seeing these rates of single family at 8%, right? Kind of around that range. And I've been sharing with them that it's not uncommon to get much more profitable rates or better rates for multifamily, especially compared to other commercial asset classes. Why is that?
Yeah, I mean, a lot of that is just because of the safety of the asset class. I think lenders in general, everyone kind of realizes there's a shortage of housing, and retail, office, a lot of hotels, a lot of these different asset classes can be really affected by, what goes on in the economy, whereas everyone needs a place to sleep at the end of the day, and a home. And so there's just more insulation, I think. And then one of the biggest things is you do have Fannie Mae, Freddie Mac, and HUD providing liquidity for multifamily housing. No matter what's going on in the market, their whole goal is to always be active. And so, you're getting, and this is kind of getting in the weeds, but these Fannie and Freddie loans, the investors that are buying those loans, they kind of have an implied government guaranteed. So they trade like treasuries, and there's a safety to buying those bonds because they're like treasuries, and they have the government kind of implied guarantee behind them, where you don't get that behind an office loan or that's with a bank or any other type of loan. So that's why they're a little bit more aggressive as far as just the pricing. But you're right, yeah, there's a huge, you might be at 5.5% right now versus 7-8% for a single family loan.
Yeah, appreciate you sharing that. I think it's so important to understand that, especially in today's market, because you're trying to find, but people right now are in what we've been experiencing. They're in a wealth preservation mode. They're not looking to 10x their money. They're not looking to 4x it in 18 months like people were experiencing the last couple of years. They're in a wealth preservation mode. They still want their money working for them. So where do they feel most comfortable putting it?
Yeah.
And these are where a lot of our conversations are going, and why I think a lot of people are pulling from the market and transitioning into hard multifamily assets.
Yeah, and I'm sure some of those people are seeing, these rates at 7-8%. They're like, man, that must really affect the multifamily market as well. But if you think about it, when rates go up that high, that cost of mortgage is substantial. And then all of a sudden that cost of home ownership is substantially higher than a multifamily property. And it just makes the multifamily rental look that more attractive. You have more people that are going into multifamily rental because it's too expensive for that mortgage, or all of a sudden they were looking at a 4% rate, now that's 8%. The down payment they would have to put in, everything changes greatly because of the payments, et cetera. So it really is a benefit and a help to the multifamily market.
That's awesome. So share with us a little bit about what you're seeing in the market in regards to these people that were getting into these very cheap loans, high leverage, cheap, low interest 2 to 3 years ago.
Well, transaction volume is down considerably. The first quarter, it was the slowest first quarter since I think 2011 or 12, just because there's such a bid-ask gap between sellers and buyers right now. Buyers, bought these properties in the last 2 years, let's say. Values have potentially come down a little bit, or they're over leveraged, and it's hard for them to sell or refinance. So there are going to be opportunities. I think everyone right now that's looking and kind of looking for opportunities is, it's kind of a wait and see approach. We're definitely not quite seeing quite as much activity. We're really busy underwriting these deals that were placed with kind of cheap bridge financing. Some of them are fine. The great thing is, pretty much every property we underwrite, the sponsors are doing great. They're outperforming their pro formas. The occupancies are great. Rents are going up. The problem is interest rates have gone up so fast over the last, I guess 18 months or so here, that it's hard to catch up unless you have an interest rate cap or whatnot. You can't move your NOI fast enough to be able to refinance out. So a lot of these groups are kind of looking at more of a long term, like we need to hold this for another year or so. We need to continue to turn the units. But there are going to be some folks that were a little over leveraged. Their capital, going back to your capital stack, they may have a senior loan that was very high up. They may have put some additional kind of financing in front of that common equity that is expensive, and it's tough to pay, and they're going to have to kind of work through that and figure out how to get through those situations.
So it's putting some groups in a tight spot where what we've seen, they either need to sell, which a lot of them don't want to do unless they're forced to, but the other option is to recapitalize. They might do a capital call, or bring in some additional investors to get that equity to where it needs to be so that they can refi into
Yep.
more profitable terms. Are you seeing quite a
Yeah,
bit of that on your end?
those two things are absolutely on the forefront right now. The issue is no one wants to bite the bullet yet, so they don't want to have to do a capital call. They want to just see if they can, their loan might not be due to the end of the year or next year. So like, let's just kick the can down the road. Let's hope that rates go down. It helps us get some more loan proceeds. We don't have to do as big a capital call, or we don't want to sell right now because there's so much uncertainty in the market. We feel that, cap rates might trend back down. So it's a little bit of a cat and mouse game, and you got a lot of folks on the sidelines just waiting to take advantage when that happens.
And you and I were talking before we started inviting others on and recording. A question came up a few weeks ago in our group about foreclosure opportunities. And you and I were talking a little bit about the differences between what you might see in a single family foreclosure versus a multifamily. So can you take a couple minutes and speak to more of what that
I'm
process
well
looks like?
versed on the single family version, but my belief is that those get through the system very quickly. They go from the lender or whoever's servicing that loan to like an auction site or to even the court steps in the municipality or wherever they're at very quickly. The difference on the multifamily side is a lot of these loans, even the bridge loans that were done over the last few years, are pooled together. They're chopped up, they're sold as bonds, and they have special servicers, primary servicers, master servicers, and these are big transactions. Typically, the borrower is trying to negotiate with them. They may kick it into special servicing in order to start the conversations about negotiation. The process is just extended much longer. And even if the guy's like, hey, they're just like, let's get the keys back, that special servicer may hold on to that asset. They may put a new manager in, try to attain as greatest NOI as possible before they provide that to a brokerage house that's going to go off and try to sell it for the highest price possible. They may also at some point put it into an auction kind of system as well, but typically those are sold through the brokerage community just in order to try to recoup or try to get the highest value possible. But sometimes these servicers might hold on to an asset for a year or 2 years. They get fees, they manage it, and they're going to try to extract as much NOI as possible to put that property in the best light, just because the deal size. So it's a little bit longer process.
Right. It can be a much longer process. And if you think about it, you're dealing with multi-million-dollar assets, not a $200,000 or $300,000 house. So there's a lot more value in trying to make it work, rather than just foreclosing, because there's a lot of time, a lot of work, a lot of stuff that has to happen to go through that point. So
yeah, and I think you go back to the asset classes, multifamily, I mean, it's still performing very well. Where you're seeing and the news is hitting right now is on the office sector, because there's so many of these properties that are 50% occupied. They don't really see a way out. They're very capital intensive. And so those are the ones that are being kicked back to the servicers and the lenders. And I think the reason you're seeing that is there's less optimism about, getting that property leased up. The office leasing and, people that are actually going to work is, there's not much, positivity really in a lot of markets around the country on that. So I think that's why you're seeing a little bit of a flood to that right now.
awesome. So in the next 5-10 minutes or so, then we'll open it up to some Q&A. If somebody's looking to purchase or get involved with another group that's currently purchasing multifamily, what are some things, red flags that you would advise people to, or questions to ask when getting involved in deals right now? And what could they expect on a lending standpoint?
Well, I think the most important thing is just how have you capitalized your deals historically? We were talking earlier, I'm a passive investor with different sponsors. The sponsors that I've invested with that did fixed rate financing, at the time, it may have not have been as attractive as the high leverage, kind of fix and flip financing. But all those guys right now have no issues. They have no loan maturities. They have no rate caps. The rates are fine, and they have lower loan to values. So we're still getting distributions. Everything's going great on those. So I think it's going back to say, how have you capitalized historically? How are you capitalizing this deal now? Are you doing a bridge loan now at 8 or 9% or 10%? Or are you going to raise more equity and have it be a more safe transaction? I think right now, and in general, I think we've learned our lesson again. It's just, how conservative is the capital stack? When you start to get your leverage up in, the 80s and 75, 85%, obviously that's more risk to the capital and to your equity. So I think that's one of the most important conversations. And also just how is your current portfolio performing? Because if you're buying a new deal, is there anything in this previous deals that you've bought that could trigger something to affect your new deal that you're investing in? So I think that's an important topic as well.
As a passive investor, do not get that what would I call this? I'll have to come up with a term with it. Don't get caught up on the shiny high 20% average annual return. Some deals can produce that. I'm not saying that they're not available, but find out how that deal was underwritten. What are the loan terms in place? Were they expecting to exit in 2 years, so they only got a 2 or 3 year loan? Because what if the market shifts again? So there's all these different factors that you want to look into before you invest in a deal. Don't just look at that high projected return. Say, hey, great, I'm going to do this. So those ones that got into deals, Brandon, you mentioned earlier, that were doing fixed financing, their returns probably weren't as sexy looking as these 18, 20%, but I can almost guarantee you they're sleeping a lot more comfortably at night right now.
And you're still getting quarterly distributions, where a lot of the other deals they pause distributions in order to reserve funds to pay for a new interest rate cap, or just because the rate's so high they can't pay cash flow. So I'm under the belief, and I've been doing this a long time, if you buy a good located deal in the right area, you're always going to be able to make money. It's how you capitalize that deal that could put it at risk when you have a loan maturity that matures at the wrong time, et cetera. So, you're levered too high. So I think, especially if you were talking about capital preservation, maybe being a little more conservative on the debt so you don't, potentially have a gun to your head down the road, I think is an important thing. I think you mentioned another great thing. How are they underwriting the deal? Rent growth is definitely slowing. And so if they're showing huge, 20+% IRRs, even higher than that, what rent growth did they use? Did they use a 5 or 10% rent growth per year? That may not be necessarily realistic. You kind of want to maybe make sure they're being conservative on their rent growth and still able to hit those numbers they're talking about. That's one of the biggest things we see people do to kind of juice those return numbers.
If there is one piece of advice you can give to our listeners on this webinar and those that are tuning in live on our social media platforms, what would that advice be? That one thing?
I think it comes down to, first and foremost, sponsors. There's a lot of sponsors out there, making sure your sponsor, good times, bad times, has experience, can get through. They also have the financial wherewithal behind them to potentially help feed some of these deals if they need to and don't need to do capital calls, and just have the experience that they can get through any situation, that comes up.
Love it. One of the number one question that we're asking current operators as we're vetting them before we invest with them is, have you performed a capital call? Now, capital calls happen. It's not a make it or break it for us, but I want to know, have they performed a capital call? If so, what triggered that? What did they learn from it? And what do they have in place now to prevent it from happening again?
Yeah.
So that's a really big question I would ask if you're looking to passively invest. Have you performed a capital call? And if they haven't, especially now and over the next 6 to 12 months, what does that say? What does that tell you about how these people capitalized their deals initially? They
Mhm.
probably got the right loan in place and they had enough reserves in place.
Yeah, and they raised enough, and we were talking about a group that we've both invested with. They've raised enough to have some reserves to, if a CapEx something comes up they weren't expecting, or to pay for some interest shortfalls, et cetera. They have that in place, but also they weren't trying to financially engineer these deals. When cap costs got very expensive with rates kind of moving up, a lot of groups were like, well, let's just buy a shorter cap. Let's buy a 1-year cap or a 2-year cap. And instead of buying the 3-year cap that you were typically required to, and that's just put them in a tougher spot, because now they have to go buy another cap and it's very expensive. And a lot of them have to do capital calls just to buy that cap.
Absolutely. There's one chart, there's a picture here I want to share with you. I wasn't planning on presenting this, but given the topic of the conversation, and Brandon, you brought up office space, I think this is really important to take a look at. So I'm going to go ahead and share my screen real quick. So if you take a look here, this is a chart actually put out by CBRE. This was back in 2008, 2009 recession. So your dark green, that's your multifamily, lime green industrial, blue is office, pink is retail. So on the left side of this chart, you have the rent decline from the recession. This is back in 2008, 2009. You can see that multifamily is just below 8% compared to these other commercial asset classes that are more than double that. So this is just the rent decline, right? At the time of that recession. On the right side of this chart, you have the rent growth. So how quickly, on the left, how hard did it get impacted? On the right, how quickly did it recover? Look at this for multifamily. There's no comparison when it comes to industrial, office, and retail. So I know people like industrial, they like office, they like retail because you get a tenant in there and they're there for 3 or 4, maybe 5 years, right? Maybe longer. So some people like that. But at the end of the day, at REV, we focus on the basic human need. We focus on multifamily because it is a as long as it's purchased right and capitalized with the right loan and the right team, it's kind of difficult. Not saying you can't lose, it's kind of difficult to lose just
Well, I think
because
what's interesting too about what you're showing here is that, that 2000 to 2009, 2008 to 2009, the reason you had negative rent growth is because we had just so much single family supply, and some multifamily supply. Really, you don't have that single family supply now. We're everything you read, you won't find anything anywhere that we're oversupplied for single family. So, we may be coming off a little bit on rent growth from these 20-30% rent growth years we've had over the last few years. But I honestly think we're going to continue to see rent growth in the multifamily sector, just because there is such a shortage of housing.
And one thing I love about Phoenix too is back in 2008, 2009, a lot of the economy, a lot of the jobs were built and tied to rooftops. It was tied to construction. So when construction flopped, when the housing market flopped, everybody left. Everybody took off. And so that's why we got hit so hard. And Arizona, they had a meeting of the minds. They came together and they said, okay, we don't want to experience that again. We're the laughing stock of the country. What can we do to make this better so it doesn't happen again? And they started becoming much more business friendly. And we're seeing that. We're seeing all these tech companies flowing in. We're seeing this Taiwan semiconductor plant coming in. We're seeing all these manufacturing plants, industrial warehouses, Amazon, right? All these businesses are starting to flood in. So now the economy is much stronger and it's not tied to more of a single area as it was back in 2008, 2009. So yes, even though house prices are going up, rent's going up, guess what? So is population. So is jobs. So is the median household income. All these metrics are moving up together. And I think that's what's important to view, not just in Phoenix, but other markets you're investing in. You want to make sure that all these metrics are moving up together, because that shows and signifies a healthy market, if you will.
Yeah, at the end of the day, job growth drives everything. Job growth and population growth. So, a lot of these, the manufacturing, the Taiwan semiconductor, a lot of these jobs that have been announced in Phoenix, and you look at Austin and some of these other markets, those jobs aren't even there yet. So, and all these home builders really from the last downturn, really it's down to like 4 or 5 public home builders that are building all the houses. Those guys are going quarter to quarter on what they're doing, and a lot of them sold a lot of their lots, et cetera, or they dropped their land, and so they're going to be, definitely behind the 8 ball as more and more of these people start moving here for these jobs that have been announced.
Awesome. Great stuff. Well, we're about 30 minutes in. So what I wanted to do now was open it up to any Q&A for anyone that's on the call, that they can, while you got Brandon here, he's an expert in the space, expert on these loans, ask them. Take advantage of this time to ask those questions or clarification on things that you might be uncertain about.
I got a question. Thanks. Can you hear me all right?
Yeah, go ahead, Clint.
Okay. Hey, thanks, Dallin, for setting us up, and Brandon for coming in. I was talking to Dallin. I think it might have been part of the reason he asked the question about, if there's a foreclosure on a multifamily or what the process. I think I've asked a lot of people, that have been over leveraged. We're seeing a lot of that in the market research that we're doing on multifamily, is people who are in bridge loans that are coming due, and seems like they're inflating their rental rates, what they're currently getting and what their potential to get for these in the near future. And so I was really curious as to what the next steps and the evolution of that, and you really helped clear that up. So I appreciate that. With the holding, if there is, do you see an increase in the number? So there sounds like there's a process in place that the people dealing with this have in place to help secure that value for, or so that the market doesn't fall out. Is there some sort of constraints on the size? Do you see that there's going to be a large influx of units coming onto the market, or is this kind of going to be tapered in, or
I honestly think that a lot of these multifamily deals that do go are going to go I mentioned that the process is pretty quick. It all depends on if the borrower, like, how much are they off? Like, is this all of a sudden they've lost 20% of value? Maybe it's something with the little submarket that it's in. Maybe it's something with the asset. It's 20% off, or is it 10% off? So I think a lot of these groups are going to go back and try to renegotiate. You don't see this on a single family. It's like, I lost my job, I can't pay it, here's the keys. But on these, there's a lot more negotiation, business tactics that are kind of involved. So they may go back, and one of the things we saw during the last downturn on commercial real estate, if you lost 50% of the value, there's nothing really you can do. You're like, I'm just going to give the keys back and try to start again at some point. But if you just lost a little bit of value and maybe your cap stack isn't right, there's something called like an extend and blend. So maybe the lender will say, all right, we're going to bring your debt rate down from wherever it is to something more manageable. We're going to extend you a year or two, and we're going to, watch you quarter to quarter and see if you can kind of work your way out of this. That may be an option to kind of preserve the lender's capital, especially if all of a sudden that value, because they're going to go to the brokerage community and get broker opinion of values. And they're going to look at that and say, okay, well, the value is below our loan amount. If that's the case, maybe they're going to take the property back, try to increase the NOI, and then sell it to somebody like yourself. Or if it's not really, it's just the equity is potentially wiped out, but their debt isn't wiped out, then they may just kind of work with the borrower a little bit to see if they can, extend this and blend it. It also depends on how the borrower reacts and how they're acting. If they're somebody that has pretty well financially healed, they have experience, they're doing the right things, they're much more willing to work with you there was just a big, in Houston, there was a big portfolio that went back. From my understanding, that borrower wasn't working with the lender. They weren't doing any of the right things. And so in those scenarios, they're just like, well, we need to get these assets back and preserve what we have there and try to improve kind of the asset quality so people can actually rent them and bring the NOI up. So it's kind of, that's not a really good answer. It's kind of a complicated, there's a lot of different ways that these could be structured to kind of work out or just go straight to kind of a foreclosure.
No, it's a good enough answer for me. It helps, like, in having no understanding of it, to somebody who dealt with it, that helps me more than I could probably even, digest right now.
Yeah. So I think it's going to be important to be in touch with the brokers that are selling multifamily, because these lenders are going to call them, ask for opinion of value, and sometimes they're like, hey, do you have somebody that will buy this deal if we take it back? So it's just important, I think, to be really in communication with the brokerage community there.
And the other thing you mentioned was and it's been brought up on the graph as well, is the office space, and how there's been a lot of concern about lending and, as an investment office, and how it seems to be kind of crumbling right now. Also, tends to be some conversation, some action around turning this office space into multifamily housing. And if you've seen any of that going on, like just kind of taking an asset that's under
Central and Camelback, they've been working on for years. Office is really tough. It all depends on the floor plates. So it's really tough sometimes, depending on how those floor plates are laid out, because you could have interior units that have no windows, and just the plumbing, mainly the plumbing and the drainage for adding all these units. I honestly think the hotel to or motel to multifamily is much easier. It's just very expensive from what we've seen in most cases to turn an office into a multifamily, unless it's pretty skinny floor plates and you can get the windows to room kind of ratio correct. Otherwise, you could have a lot of rooms with no windows there, and just the cost of, potentially we're seeing the pricing of offices come down quite a bit. Maybe it makes sense if it's in a great location just to raise that building and build a new multifamily.
Cool.
Office, all just based on, like, it's so capital intensive. You're always having to do big tenant improvements for the tenants every few years, and to get tenants in there, that's one of those assets. It's all about your buy.
Yeah.
There might be some buying opportunities coming up here for office. You never know.
I heard, so some of the Blackstone, seeing them walk away from stuff, a term or distinction that we saw come up with them was a 30% replacement price. Like, that was what they're looking at, and they're just walking away, right? If they can replace it at 30% of the cost or whatever it was, which I thought.
Yeah, you look at a Blackstone, they have so much dry powder. They also just raised $30 billion of dry powder for opportunities. So they're like, let's sell it. If we just lost 70%, let's sell it, and then we'll go buy it back at, at the lower price. And then it makes sense. You see some of these institutional groups move pretty quickly because they know what they know today, and they know what they lost today, and they know they're going to be able to, they're so big, they can raise money again. Obviously, that doesn't work for a typical kind of private syndicator, because something like that happens there, it's going to be really hard for them to raise money again.
I got a quick question. Sorry, Dallin, I have to drop in a few, but so I guess the folks on this call were all pretty big fans of this multifamily, kind of opportunity, in terms of assuming it's structured properly, like you're talking about. Just kind of wonder, are there any assumptions that we're making, or possible events like in the macroeconomy, whatever, that would kind of make it bad all of a sudden, like kind of blow it up?
Well, I think just, we have a huge increase in the jobless population. Obviously, you have to have jobs to pay rent. So I think that's the biggest thing, just the overall economy. Don, I'm not sure if you have any additions to that. So just overall economy, if you go 10, 15, 20%, jobless rate, those are going to be people that potentially they're not going to be able to pay their mortgage, and they're probably not going to be able to pay their rent as well if they don't have jobs. So I think that's the biggest macro kind of that could really be a factor.
Makes sense.
And piggybacking on that, Brandon, that's why we focus on B and C class assets. That's your working middle class, if you will. People that are making anywhere from 50 to a little over 100,000 a year. We don't get into the class D or the C minus, these properties built in 1960s or 70s that are heavy repositions, because there's a lot of work that goes into that, a lot of variables, a lot of moving parts, and you're attracting a different clientele, if you will, a different tenant base. So we target that working middle class because they've got cars, they've got payments, they've got families, right? So they're always going to find a way to make things work. And so I think it's important to understand who you're targeting. We don't go for top end luxury where people are spending $5-6 grand a month on their penthouse suite. We don't do that either. So I think that's a big part is the jobs and the economy. And I think we're in the middle of the unexpected with interest rates right now and loans. Like, I don't think people were anticipating raises, but not at the rate that we have been experiencing. So I'd say we're in the middle of it right now. And then the question is, like, how can it get worse? And nobody has a crystal ball, right? So I think just taking a look at where we're at, making sure that you're still buying properly and being conservative with your underwriting, making sure you're well capitalized. And what we're doing is really educating our investor base. If you're looking for an 18-20% return right now, we're not the ones for you. And you can go find another group that might be projecting that. And if you're comfortable and they've got that track record, then go for it. But we're in a process of readjusting expectations because there is so much unknown that's happening. So every group, every operator, every person you talk to is going to have different thoughts and opinions on that. So at the end of the day, do your due diligence and go with your gut.
Yeah, I think real estate, location. So, why do people live there versus down the street and whatnot, or a different area, and just kind of really understand the brick and mortar of the actual building you're looking at.
Thanks. Awesome.
Brandon, I have a question for you. Thanks for coming in today. I want to see what suggestions you have for a new syndicator trying to do deals this year in the current market conditions, particularly from the lending side, creating a relationship with the lenders. Yeah.
Well, I feel like first and foremost, I think it's a great time for a new syndicator, because a lot of the very active syndicators over the last few years are kind of are not really looking for new acquisitions. They're asset managing, making sure they're taking care of their portfolio. So a lot of the buyers we see right now are new to market or new syndicating buyers. From a lending standpoint, I think it's just important to, as you're looking at deals, to kind of be working with somebody that can underwrite the financing very quickly for you and tell you, all right, this is what the different financing options look for each deal, and kind of making sure we have a story put together on your experience. Maybe you've been a passive investor for a certain amount of deals or a certain amount of years, and now you're going to the active syndication. One of the biggest things we lean on with new syndicators is management. So because at the end of the day, you really got to have the right management. So we'll recommend certain managers, have you interview, certain managers, property managers, in different markets. And that's what we really lean on with a new syndicator is, they have their net worth and liquidity. They raise this money, this deal, but here's who's actually their third-party professional management they're putting in place to run the day-to-day operations at the asset. That's kind of what we really lean on for new syndicators.
Okay. Another follow-up question is, I know everybody's talking about the agency loan these days, right? Yeah. So is it worth of a time to, if I'm looking at a deal, is it worth of a time before the LOI is accepted during the underwriting process to reach out to these agencies who can offer the agency loan, if this deal would qualify for agency loan, or if these indicators with that background would qualify, or is it something worth of a time to do after the loan?
100%. We, as agency lenders, we are working with groups like as they first look at the deal before they even get accepted for an LOI, because they want to know what it looks like. They want to know what the financing looks like, and every deal is structured differently with the agencies. So their pricing can vary very widely based on how much mission is something we talk about mission, but what the rents are to area median income. So if it's higher mission, that's going to give you a lower rate versus kind of just a purely market rate deal. So, and you might be able to get 35-year amortization versus 30-year amortization. There's just different bells and whistles on acquisitions that are available different depending on the property and, you know, the makeup of the property. So we're always working early and often with groups on different options, either with us as a Fannie Freddie or even some different options with bank, et cetera, just so they know kind of going in, all right, this is what we can kind of expect. How does this look for what we were thinking? Because a lot of times new syndicators are like, well, we want 75% leverage. Well, that leverage is all dependent on the cash flow of the asset. So, you know, and the cap rate. So you might be lower than that. So that kind of adjusts their expectations for equity, et cetera.
All right, thank you.
Awesome. Well, folks, appreciate your time. In the chat box, I just sent a link. If you're not in our investor portal yet, make sure you get there. It's not a commitment to invest, but what it does is it gets you into our system. We actually have a really cool opportunity coming up in a few weeks that we're going to be introducing to our network in our portal before everybody else on our email list. So if you haven't had a chance to sign up yet, it takes 30 seconds. That gets you into our system. Before we work with anyone, we want to jump on a call with you too. We want to make sure that the alignment is there, because if it's not, then there's no reason to start discussing details of a deal. Because that's first and foremost, you got to understand when when you work with an operator, when you work with REV, it really is a partnership. You're buying membership units in that LLC. It's very much a partnership, even if it's in a passive role. So we still full-heartedly believe that alignment needs to be there, whether you're passive or not. So click on that link, sign up in our portal. If you haven't already, you'll be able to see previous deals, and you're also going to be notified of this opportunity that we're coming out live in I'd say probably about 3 weeks from now. So if you want first crack at that, we do have an early investor incentive worked into that, and happy to discuss more of that with you once we jump on a call. So get into that portal, sign up, get into our system, and appreciate you all coming out today. Brandon, thank you so much. This is, especially now, this education is, it's vital. And for you, all of you on this call, this is the number one thing that we're asking current partners about. What type of loan are you putting into place? What can we expect, right? How long are the terms? What are the interest rates? Did you purchase a rate lock on it so it won't increase? So it's very important to be talking about these things, especially now. So appreciate you all coming out, and we'll yes, next week we'll be going again. So 10 to 11 o'clock. If you connect with others that are looking for additional education, invite them out. Invite them out. You guys have been on this call before. You know what we're all about, and it's really just spreading the love and the education so people know that these options are out there. So appreciate you all jumping on, and we'll catch you next week. Thanks a lot, Brandon. Appreciate it.
Guys, appreciate it.